Hey everyone, welcome back to the channel. Today we're diving into a topic that's critical and has affected millions of homeowners across the country, especially during times of financial uncertainty. If you're watching this video in real time, we're beginning to see a rise in short sales, foreclosures, and deed in lieu. So this is a topic that will be trending for the foreseeable future. The main question we're addressing is what happens when someone can no longer keep up with their mortgage payments. We will break down three common outcomes: deed in lieu, short sale, and foreclosure. Now let's start with a quick foundation. Default occurs when a borrower fails to meet the terms of their mortgage agreement, usually by missing payments, but it can also happen if they let insurance lapse, or they fail to pay their property taxes, or if they just let the home fall into disrepair. Once this default happens, lenders have several ways to respond, and foreclosure isn't always the first or best option. What is foreclosure? Foreclosure is the most severe remedy. It's a legal process where the lender forces the sale of the home to recover the unpaid debt. This is costly, time-consuming, and publicly damaging for both the borrower and the lender. This is essentially the borrower saying, "I'm not paying you anymore, and if you want the home, come and take it." Once the lender goes through the timely and expensive process of removing the borrower from the home, they will sell it at auction and then pursue the borrower for the difference. And that's the difference between what they owed and the cost they incurred minus how much they were able to receive for the sale of the property at auction. This is not a good scenario for anyone. Remember, lenders don't want to own homes. They want performing the homes. So before going down the foreclosure path, many lenders will entertain loss mitigation options like a workout plan, a loan modification, a deed in lieu of foreclosure, or allowing a short sale. So what's a short sale? A short sale happens when a borrower sells their home for less than the remaining mortgage balance, but with the lender's approval. Let's say your home is currently worth $300,000, but you owe $350,000. You would hire a realtor to list your home, and let's say he finds a buyer willing to pay $295,000. You would send the transaction documents to the lender and ask them to accept this lower amount and forgive the rest, or at least some of the debt. Now you may be wondering, why would a lender agree to that? Well, there's actually more reasons than you would probably think. A short sale is often less costly and faster for a lender. A foreclosure would require the lender to pay an attorney to perform the procedures. Then the lender would have to take over the utilities, probably make some repairs, pay any violations for lawn mowing or code violations, etc. These would have occurred while there was no one living in the home. Then they would have to hire someone to take on those activities, turn on the utilities, hire a realtor to advertise the home, conduct showings, and after all of this, they may only end up with a buyer willing to pay $295,000. This will also be better for the borrower, as it is usually less damaging than a foreclosure, and they may be able to negotiate the forgiveness of the remaining mortgage balance. Now, the downside for the borrower is you cannot complete the sale until the lender has approved the transaction, which can be a very slow process. Sometimes these transactions can take up to 6 months. You may also still owe money afterwards, depending on how the agreement is structured. And there may be tax ramifications, even if you get all the debt forgiven. And it does not save your credit, but it will not be as damaging or as severe as a foreclosure would be. Another option may be a deed in lieu of foreclosure. A deed in lieu of foreclosure is when the borrower voluntarily gives the title of the property back to the lender. Essentially, the borrower is saying, "Here, I can't do this anymore. Let's part ways. Here's the home back." The lender then takes ownership of the home, and in most cases, the debt is forgiven. This route avoids court. It's generally faster and looks slightly better on the borrower's credit report than a foreclosure, but there are risks for the lender. If there are other liens on the property, a second mortgage, an unpaid HOA due, mechanics liens, those actually stay with the property in this scenario. The lender inherits those headaches. Those would likely have been wiped out in a foreclosure and would have been negotiated prior to close in a short sale. Also, it's important to note that if the borrower files bankruptcy within a year, courts could undo the deed transfer, arguing it was an unfair asset disposal. So this can make lenders more cautious when going this route. But let's recap these options from both parties' perspective. First, if the borrower cannot continue to make their payments, they should immediately contact a lender, explore what loan modifications they can offer, especially if the issue is temporary. If staying in the home is no longer viable, a short sale would allow the borrower to come to some type of agreement and have some control over the process. If a short sale is not feasible, then a deed in lieu would be another option. Foreclosure should always be the absolute last resort. The bank is usually interested in working with the borrower, but their preference will vary depending on whether there are any junior liens in place, what other assets the borrower has, and just how far below market value the property has gone. Remember, mortgage distress is serious, but there's options out there for both parties, and good communication goes a long way. Whether you're a borrower, an agent, a lender, knowing these distinctions can help you make the smartest decision when times get tough. If you found this helpful, drop a like, leave a comment, and subscribe for more real estate insights. Until next time, stay informed, stay empowered.